Hey, welcome everybody. My name is Tyler Hood. I am the Relationship Success Supervisor here at NuView Trust. Honored to have Mr. Richard Hilson join us today to discuss the 60/40 is dead, the case of alternative investments. But before we get started, just a quick disclaimer here from NuView Trust. NuView Trust serves as your custodian for alternative investments, but we do not provide any tax, legal, or investment advice, nor do we sell investments. We custody IRAs, ESAs, HSAs, and 401ks that hold alternative investments chosen by the client. We encourage you to seek legal or tax advice as necessary and to perform your own due diligence before engaging in any investment vehicle or strategy. And as I mentioned today, we have Mr. Richard Hilson with us. Richard Hilson is a financial services entrepreneur and an expert in the field of alternative investments who studied law at the University of Nottingham. Before founding Hillson Consulting, he co-founded Third Seven Capital LLC, a privately owned boutique investment bank specializing in alternative investments, and was also CEO of an RIA aggregator. Richard is a British national who began his career at Barclays Wealth, and since that, he has worked with a variety of companies as an investor, banker, strategic advisor, and board director. At Hillson Consulting, Richard's focus is to work with advisors to improve their offerings, particularly relating to alternative investments. Through this, he is educating advisors and their clients on the misunderstood asset class and helping them navigate access to the best of breed offerings. Finally, he writes discussion pieces for leading publications, and his educational presentations on alternative investments are CFP CE approved. He was even recently asked to adapt his presentations to be a business school guest lecturer in 2021. All right, and Mr. Richard Hilson, thanks for joining us today. We're excited to have you.
Thanks. That's a very kind introduction. And I actually realized when you gave the title, it actually sounds like a crime novel. 60/40 is dead. The serious case of the alternative investment. So I'll remember that. I'll remember that next time.
Sure to be a bestseller, definitely.
Thanks for the kind intro, and thanks NuView Trust for inviting me. You guys are my go-to custodian in the alt space, and we do a lot of things together. So I appreciate you inviting me today.
Thanks for joining us.
All right, let's go with screen share on my side, and we'll get rolling. 60/40 is dead, the case for alternative investments. Like I said, I've just realized it sounds like a crime novel, but it's intentionally provocative here. I don't believe 60/40 is completely dead. I believe it does form a part here, but the idea is you've got to poke people sometimes because there's too many just stuck in 60/40 alone, and therefore I'm not even going to apologize for being intentionally provocative here. But this is really about why alternative investments should be the driving force behind everything that advisors do, whether it's business development or whether it's different asset classes offering less correlation to equity markets. So 60/40 is dead, the case for alternative investments. We'll do Q&A as we go. I've actually asked NuView to kind of keep their eye on the Q&A bar, because actually while I'm quarterbacking the slideshow, it's actually difficult for me to do. If there's any questions which fit really well with what we're doing and are pertinent as we go along, they'll interrupt me and we'll address that. If not, we'll hold them to the end when we've got 10 minutes of Q&A. One other piece of housekeeping is if you're looking for your CFP, continuing education credits, you do need to stay on for the full time. I've had awkward situations where someone's dropped off 49 minutes into it and don't get their credit, but unfortunately that's the rules, and we do need to submit an attendance minute by minute kind of system to them. So you are stuck with me for the full hour if you're looking for your credits. I apologize for that. Here's their standard language, 1 CE credit hour, CFP board. You do have to stick around for the full amount of time there. Okay, Tyler did a great job of introducing me, but that was probably a little bit more of my background rather than my current raison d'etre. So I believe that alternative investments are misunderstood, underrepresented, and need to form a part of every portfolio. And how do we fix that? One client, one advisor at a time. Anything that fits within the realm of making alternative investments easier to understand, more easily accessible, anything that falls within that remit is in my wheelhouse. So work with advisors, sometimes helping them understand the asset class, helping them navigate the asset class, helping their clients understand, or help the advisor with their messaging to clients, so that alternative investments are less misunderstood. And sometimes work with custodians, product sponsors, other product providers with their messaging, their education. We are struggling to get our message across with advisors. I don't think it's because we have a bad product or anything. It's just this kind of stigma around alternatives. Great, that fits perfectly on my side of things. So that's really my wheelhouse, is anything which is helping make alternatives more accessible on either side of the transaction is my wheelhouse. There was a disclosure on the last slide, which is basically, this is not an offer to sell, nor any kind of solicitation. This is educational. This is very generic about alternatives in general. Excuse me, alternatives in portfolio construction, understanding and navigating alternative investments. So nothing product specific here. If anyone wants to talk in more detail about any of this, then my details will be at the end. So let's start with, at the highest level, but also at the most problematic side here, is what are alternative investments? Problem number one, and the biggest problem, comes at this very point. The fact that, and just, this is a broad spectrum of what can fall into the alts category, but already we can see, just picking some random ones here: real estate, hedge funds, infrastructure, commodities, private equity, venture capital, art and antiques. That is a really broad spectrum of different things, and that in itself is a massive problem. How can you put whiskey casks in the same categorization as oil and gas royalties, mineral rights, or something like that? How can commercial, low volatility real estate fall into the same criteria as hedge funds or venture? It just doesn't make sense. And so this causes problem number one, which is every week, if not every other day, I have a conversation with either an advisor or a client, and I say the dreaded A word, alternatives, and we get just a visceral bodily reaction, is people tensing up because they assume that alternatives has to be high octane. They immediately think Bobby Axelrod from Billions, black box hedge fund strategies, crypto, high risk venture. And actually, I mean, it can be a very conservative, low volatility, predictable asset class. But again, this everything lumped in together is a massive problem. And so when I speak to an advisor or a client that says, "Oh, I once had a bad experience with venture. I'm never doing alternatives again." Well, okay, well, don't do venture again. But does that mean you shouldn't do real estate or oil and gas? It's nonsensical. That's like saying, I once had a bad experience with a stock, so I'm never picking a stock again. It doesn't make sense. I was involved in a transaction last year, which was a Amazon distribution facility, triple net lease project. And investors got a chance to get, I think it was a 5.5% yield in an Amazon distribution facility with Amazon as the tenant, and therefore the main risk is Amazon defaulting. Most stock plays that I know are actually more volatile or risky than that. So when we get this just overreaction because of this terminology, it's a real issue here. So the terminology itself causes a problem, and we can't group everything together. If clients or if advisors don't like crypto, they don't like venture, don't do crypto or venture, but don't write off alternatives altogether. 60-40 allocation defined. So this is still taught in business schools. 60% stocks for capital appreciation, 40% bonds for yield. This is the traditional approach. Still taught in business schools. I disagree with that vehemently. I think it's a broken model on its own. It can still form a part of the portfolio, but we still need to have alternatives forming a part of the portfolio, depending on client circumstances, would determine how much allocation would make to alternatives or to which verticals within the alternative space. But I liken this, you'll realize as we go along is I like my analogies. And this reminds me of when I was back in high school, during, I guess, like some kind of biology class. They taught that a typical human diet should be 70% carbohydrates, 20% protein, 10% fat. And that basically screwed up a generation and created, I mean, there's other reasons for it, but created a lot of overweight people who were trying to eat well and thought fat was the enemy and carbohydrates was the friend. And nowadays that's almost turned completely on its head. I liken the 60-40 to that. The fact that it's still taught in business schools is criminal. It's an out-of-date model on its own. The 60-40 can form part of the overall portfolio, but there need to be less correlated alternative asset classes in there. The 60-40 alone doesn't work. I know that we've had a strange kind of 10 years where it's predominantly been a bull market, and until recently we hadn't had many major long corrections. But the old model, which they teach in business schools, is 5-year period, 3 years up, 2 years down, and hope that you net 1 year, 1.5 years out of that. That doesn't make sense to me. I'd rather be able to get gains, even if it's a yield-based real estate play or something like that during a down market. It just doesn't make sense to me. And the last time I did this presentation was before we saw this rather significant correction or the start of a serious downturn in the equity markets. But this really good almost 10 years of performance that we had, I believe, made advisors complacent, and rightly so. It's damn hard to move away from equities when equities are performing really well. But advisors kind of waiting for this, well, we're not seeing a downturn yet, I'll just hold on a little bit longer, made them complacent. It's hard for people in life to get outside of their comfort zones. But the time was 6 months ago to prepare and get comfortable with alternatives and prepare for an inevitable downturn rather than firefighting at the last minute. So it's not too late, but it can't be the case where because the equity markets have been kind, we're just so tied to that. That's not good money management in general. Okay, so let's talk about the problem with 60-40, which again, it's a slightly different world since I last did this presentation a few months ago. But stocks have market volatility, and it's very hard in stocks alone to be a stock picker in a bear market. Even the best people struggle with the stock picking and timing aspect of thing. Bonds have had lower yields, which makes it really tough in the bond market. And cash, we've got real inflationary problems. So what do we do about that? And unfortunately, what I've seen in a lot of places is advisors say bond yields are a disaster. We don't want to be in cash. So until fairly recently, it moved to 70-30, or God forbid, even 80-20. Do you know what that did? Is not only did it cause a problem for these poor clients who were now overexposed to equities, but it exacerbated the overheating in the equity market. So we ended up with an equity market which was already due a serious correction, actually getting more money flowing into it because people were moving away from bonds and cash. It just made the problem so much worse. So historically, alts eat into the equity allocation side of things. That's often been the case, is move some out of equities into alternatives. That's also not an issue, but I think that the bond yields should be found in, or what used to be historically bond yields can be found in alternative investments as well. So it doesn't always have to be moving away from equities. It can be that 40, where if yields are not there in the bond market, there's plenty of quality, low volatility, predictable alternative investments, which are yield plays. So don't just think of the old way of we have to take from the equity side to allocate to alts. It can come from both sides of this allocation, but the 60-40 can't exist on its own. And this is even more the case than when I did this presentation a few months ago, since we've seen inflationary pressures creeping up even more, and equity markets start to see some problems which we didn't have before. So let's just move on, and I'll let you just take a look at that for a minute while I take a very quick coffee swig. So the endowment model, So granted, these guys have large teams, and if someone is a 1, 2, 3-man shop on the RIA space, then it's tough to do, this kind of due diligence that they do, this kind of selection of private equity opportunities or whatever. So I get that completely. But the endowment guys tend to be the smartest guys in the room. And so when we look at alternatives, it's been over 50% for the last 10 years here. I know that some allocation of that is them doing private opportunities, sidecar transactions, SPVs, private equity, individual transactions. I get that. So I'd never think that an advisor has got the bandwidth, an advisor who's already wearing multiple hats, portfolio manager, business development, client relationship manager, then to add the investment banker, due diligence officer. I get it. There's a lot going on there. It's rough. Too many hats, too many spinning plates. So 50%'s a serious threshold there, but this is just here to illustrate the fact that the smartest guys in the room are allocating serious amounts of their portfolio to alternative strategies, and you should be too. Perhaps not to 50%, but 10, 15, 20% is very doable. And guess what? The smartest guys in the room, the performance has been there as well. Is endowments are achieving outsized returns. Is when we look at comparing the endowments to the 60-40 portfolio, which got just over 20%, is we're looking at least a double-digit improvement from the 60-40 portfolio. And I will caveat this with endowments with some serious due diligence teams who are selecting private off-market real estate transactions, private equity transactions, secondary unicorn transactions, whatever. I get it, is that does skew these results to some degree. But I'm pretty sure that so far this year, even if you take out their special situation type opportunities, their performance has been a lot better than the 60-40 because it's not just hanging on the equity market. So easy way of saying the smartest guys in the room are allocating a lot to alternative strategies and are seriously outperforming the typical 60-40 model. I think we all might be preaching to the choir here, but the statistics back up what I think we all know here. All right, so growth in the alts market, growth of the alts market. Just look at these figures here. This is explosive growth in allocations to alternatives. And I think a lot of that is because I've said for ages, RAA assets are probably the largest untapped source of capital in the alt space. The broker-dealer market certainly does more in alts and has moved more quickly. The RAA market, and I think one of the reasons is because RAAs can charge their wrap fee, whether it's Microsoft or whether it's an alternative strategy. And I don't blame some guys who say, well, if I'm holding Microsoft or blue chip stocks under my wrap fee and getting paid the same amount, it doesn't open me up to risk in an audit or risk in terms of clients and things like that. So I get it, don't necessarily agree with it, but I understand that. So I think RAAs have been slower moving into this space, but I think we're poised for even more growth. And 81% of investors expect to increase allocations to alternatives in the next 5 years. And one thing as well, which I see all the time, and it's sad that I do, but I think that people are actually finally getting around to getting rid of alternatives being a dirty word. Is I had a conversation not long ago where I spoke to an advisor and said, what do you do in the alt space? Oh, we don't do alts. That's much too scary, much too high octane for us. Okay, you're in, it was either Texas or Oklahoma or something. You're in Texas. You must have done some oil and gas stuff. Oh yeah, we do some oil and gas stuff. Okay. Ever done real estate? Yeah, we've done some real estate projects. No, you realize these are alternatives. It's just not the crazy, sexy alternatives that you potentially come up with in your mind when you hear the word. So I think this better understanding, the educational work that myself, NuView, other people are doing, I think helps this. But again, it does break my heart that I have to actually explain to some advisors that they are doing alternatives without realizing it, and maybe when they acknowledge that, that also helps the growth side of things. So, Tyler, I'm going to ask you a quick question here. You guys are one of the leading alts custodians. You're certainly my go-to guys. We're seeing these figures about the industry as a whole. Are you guys seeing the same kind of explosive growth on your side of things, or what trends are you noticing on the growth side?
Yeah, absolutely. It's kind of a mixed bag these days between the bigger clearing firms not wanting to mess with the alternative space anymore because they know custodians like us exist. So it's kind of seeing them push and resign some alternative assets to essentially leave them to the alternative focused custodians like NuView to handle them, knowing that it's what we're purpose built for. And then, yeah, I mean, just in general market fluctuation or kind of uncertainty, it's been a crazy couple of years. There's been this push in both the end client self-directed investor and the advisor looking for what's out there that's more tangible, what's something I can actually put my hands on, or a note that I can hold, or a subscription agreement that I know exists. You know, the alternative space, because it's becoming more accessible through custodians like NuView that exist, and because of some uncertainties in the market or kind of what they're looking at changing and dipping up and down, becomes a little more nail biting, you know, the last couple of years, to where the advisors are looking to expand that alternative portion of their portfolios for their clients. So we personally here at NuView have continued to see growth. We've been very fortunate to see that growth continue through the kind of COVID years that we're going through, and even just a boom in the end advisor who is seeming to be, you know, passing around and pushing and selling more alternative product to their clients these days. So it's been kind of an exciting ride the last few years. Every year's been a good year for NuView, and it's continuing to grow. So it's been a reflection of the interest in alternatives, whether it be real estate or private entities.
Awesome. That's great to hear. Is anything we can do to make the alts market more accessible is excellent. So let's just move on to. Excuse me, I've got a pet trying to crash my camera here. So okay, so let's just move on. And Tyler, I'll have a question on this slide as well. So new investment landscape is, we've talked about the growth in the space, but let's address some of the reasons why we've seen the growth in this space. And Tyler, I'll ask you again from your side. So one of the key things here for me is the lower minimum investment amount is, and this is a very basic kind of pie chart in the bottom corner, is I've used the analogy, me with my analogies again, I've used the analogy in conversations of alts used to be the Amex Centurion card. And I think to have the Centurion card, you need to be spending like 250 grand a year on your Amex alone or something crazy. And it opens up so many doors, and it's the most high profile card out there. Alts used to be the Centurion card. You used to be a ultra high net worth or a family office or something. Nowadays, alts are available for the Amex Platinum card, which is not that difficult a card to get hold of. And it's now available for accredited investors, not just ultra high net worth, qualified purchasers, et cetera, et cetera. And one of the reasons is because the investment minimums have changed. And we're not talking investment minimums for low quality product. We're talking high quality product. Is even a couple of years ago, might have been a 250 grand minimum ticket size. So unless you want to put everything into one alternative strategy, let's say you want 250 grand a pop minimum ticket, you need $1 million in alts alone to actually get a mini portfolio. That probably means you have to be 5 to 10 million liquid to be allocating $1 million to alts. That's a decent net worth client. I'm sure we've all got some of those, but I mean, that's not the everyday accredited high net worth. Nowadays, I literally did this for a friend recently who was sitting on some excess cash and is accredited but not crazy high net worth. Is 25 grand a pop, 100 grand, and put together a nice 4-piece alts portfolio of kind of mini diversification with 100 grand, which means now it's someone who's $1 million excluding residence net worth. That is a huge difference, and like a huge difference in the books in terms of what it's available for. So the new investment minimums and the commoditization of the industry, the fact that really good quality institutional sponsors are now opening up these units for when I was at Barclays, we used to call it the mass affluent space, which is basically accredited investors, as opposed to ultra private bank, ultra high net worth. So knowledge is improving. I think clients are finally getting the message that they can get access to this stuff, and therefore are asking for it. And if they come to their advisor saying, I need some DST options and some OZ for some of my tax planning, and the advisor, number one, doesn't know what it is or doesn't have options, that's an embarrassing conversation. The media is talking about these things. We hear all the time about proposed tax changes. I fairly regularly hear DSTs and OZs actually in mainstream media, which would never have been the case a couple of years ago. So clients are getting smarter. If you don't have them, your competition will have these kind of structures. That's just the sad facts. Custody and reporting are getting better. Third-party due diligence reporting, it means that firms like McLaw, Factorite, Buttonwood, Bowman, Snyder Carney do third-party external reports on these, which really helps advisors understand when they're kind of starting their diligence and don't really know how to start adding that investment banker due diligence officer hat that we talked about earlier. Really help things. And so ultimately, quality products, institutional quality products, are now available to a lot of financial advisors and a lot more of their clients than would have been. One of the things that's on my list here is it used to be that you couldn't get onto a custodian with alts, or the fees were prohibitive, or they say we're alts friendly, but we're going to charge you a stupid fee per holding. It makes it kind of rough. And therefore, Tyler, like what have you guys done to solve that problem, and how have you kind of improved to keep up with this demand? And then also, what's on your your aspirational list of how you continue improving to make this easier for all of us?
Yeah, sure. I think a big component to all of this has been the difference in being alt friendly and being purpose built for alternatives, which is like a company like NuView is built for. So it's the kind of analogy of going to McDonald's and trying to order a steak. It's like they can probably figure something out. It's going to be expensive. It's not really what they do, but which is kind of like these big clearing firms that offer alt friendly solutions, but it's going to be a bit pricey. Or very pricey. It's going to be a lot of hoops to jump through as the investment sponsor or as the advisor or as the client, and kind of transitioning to more alt friendly, alt focused, alt exclusive custodians like NuView, and to where we are purpose built for it from the ground up. All of our systems are in place with alternatives in mind, understanding exactly how processing investments into alternatives takes place, what is required. And then once having a solid foundation and understanding of what goes into the alternative investment world, how do we make that process easier, both internally and for the end client, for the advisor, making sure you're advisor friendly, investment sponsor friendly, and end client friendly, of course. And that comes with improvement in process and technology, growing with the advances in technology in this space, understanding that the original paper copy, hand-signed paperwork of subscription agreements and the applications is no longer the case for everybody or for every investment sponsor. And as the education starts to spread, investment sponsors realize there's money to be made. There's no longer this huge barrier of entry to access the alternative space, both in investment minimums or with the actual alt-friendly custodian aspect of it. It's not this big kind of high difficulty to access type of investment anymore. And custodians like NuView, and I can speak specifically to NuView's process, it grows and changes and simplifies over time as the entire investment space gets a better understanding of how it all works. And with us here at NuView, it involves, moving towards more e-signature friendly paperwork, and then encompassing and incorporating the investment sponsors who are also e-signature friendly, and ensuring that we can do as much as we can through an email or through portal access, and growing and expanding and investing money in our own technology, internal proprietary portals, to see if we can not only appeal to the current population who is saving for retirement or of retirement age, but also aiming that towards the millennials and the Gen Zs who can benefit from this education now, start saving for their retirement, but also have a platform and technology that they are familiar with, as opposed to what's a check and a hand signature, like what's a checkbook, so just turning it more towards that technology friendly process simplification and what we do, and making sure we're rolling it out, as the times change.
Yeah, awesome. And I think you guys are doing a really good job. I have my own accounts with you guys, candidly, and it's a lot of the other custodians who say they'll accommodate alts. It's lies. They will, but they'll charge you through the nose for it.
Right.
They actually don't want to, and they don't want to say they don't want to, but they just add fees so that it becomes prohibitive. And I hate that approach. I'll actually just on this slide, there's a few things I wanted to cover, but while you're here, Tyler, so we don't keep going back and forth, is one thing that is a very common question that I get, or a perceived roadblock, let's say, is advisors often say, well, if I can't get it on my Schwab platform or my Fidelity platform or whatever, then I don't want to have multiple custodians. I'd agree with that sentiment. If they were doing 10 alts offerings and they had to have 10 different custodians, yeah, that's rough. And it's probably additional cost to actually pull together feeds and get the reports together for billing and all of that kind of stuff. I always throw it back to them and say, if NuView theoretically can hold all of your alts offerings and you have one core custodian and one alts custodian, is that really that much additional effort when you've only got two custodians at that point? And even if you don't have a electronic kind of feed pulling everything together, is maybe you bill on your alts once a quarter, and it's a little bit of extra work, but is it really prohibitive to stop you embracing what is such a dynamic asset class? That's my approach. Is how prohibitive, how much of a roadblock do you actually really think it is in practice, Tyler, if someone had a regular asset custodian and an alts custodian?
Right. I mean, happy to say, just kind of like the technology that comes with investing in this product and having a custodian that holds it, also comes the advance in technology when it comes to data aggregation and consolidation. And as the alt space grows more and more popular, so does the technology and platforms behind it that make consolidation of those custodians simpler and more accessible, whether it be, brands like Orion, who NuView integrates directly into. It's having these data aggregators, which are, they range in price point and capability, but at the end of the day, it's designed to consolidate the different custodians, the 1, 2, sometimes 3, 4. We understand there are certain custodians that only hold certain products and others that don't. But if you can boil it down to like a NuView and your brokerage custodian, having a data aggregator essentially have both portals, both feeds of your clients that hold assets and both custodians feed into a single platform that you can then go bill on, you can then go reconcile with, you can have account statements generated from. That technology is more and more accessible, and more than it has ever been. And we're seeing more and more advisors using technology like this. And again, it's not that just like the alternative space, that it used to be kind of this above and beyond type of accessibility that you would have to, access. It's now becoming more and more day-to-day mainstream, typical process and components of the advisor space these days. And yeah, it's not that big of a hassle at all, especially if you're working with custodians like NuView that are advisor friendly and understand exactly the needs the advisors have and what it takes to consolidate that information, and just generally understanding that we are your alternatives platform, they are your brokerage platform. We understand that you're trying to possibly bill on each account or both, custodians. So data aggregation helps with that, but also understanding that at NuView, we have process in place to help bill on those accounts for the advisor as well. So it's this combination of being advisor friendly, understanding that at the end of the day, sometimes it's you can't prevent having to have more than one custodian, especially alts versus brokerage. But there is technology out there to consolidate that. There are custodians like NuView that understand that and accommodate for those types of requests that involve more than one custodian. And I just like with the alternative space, it's more accessible than ever. Yeah.
Yeah. Okay. Well, I think we've answered and got rid of that. I think that, again, a comfort zone thing. It's easy to find excuses for something where, okay, it's going to take a bit of getting used to and some effort to get clients comfortable and stuff. But as far as I'm concerned, the multi-custodian and the reporting thing is actually a myth, and I'm happy to have that debate with anyone who disagrees with me. Tell me why.
Right.
I'm always looking to learn and try and find solutions for any kind of unique situations. But believe, you know, that's off the table as a roadblock. The broad terminology, we've already spoken about why are alts under allocated. With the broad terminology, I get it. The misconceptions. I work with a lot of advisors and clients. I work with a lot of sponsors to help get rid of some of these issues. Misunderstood clients had a bad experience goes back to what I said earlier about you make a bad stock pick once. Does that mean you're never picking a stock again? That's completely nonsensical. I get it. If it's a venture deal, never do venture again. Fine, that's understandable, but you can't blanket the whole thing together. And there's educational companies, there's Case. I do a lot of educational work. A lot of the custodians like NuView are putting on more educational stuff for clients as well. So the education, and I know it's been lacking for a while. We are just catching up here, but the education is out there to help advisors and help clients to understand. So custody and reporting, we've talked about. NuView, make it as easy as possible on that side of things. Liquidity misconception. Here's a big one, and we'll cover this on an individual slide a bit later. Is the fact that a lot of alts are illiquid or less liquid certainly needs some explanation for advisors and for clients as well. I wrote an article recently called "Illiquidity is Not Your Enemy" or something like that, which is on my LinkedIn, or ping me. I'll give my email address afterwards and I can send it to you. But I think that addresses in quite a bit of detail some of the reasons why illiquidity is actually a benefit in portfolios sometimes. And then a really big point here is navigating the asset class. I have this conversation all the time with Mick Law, Factorite, Altigo, where they have a platform where someone can log in and type in Opportunity Zone or DST and get a list of offerings. I see it regularly where an advisor says, all right, I need to get some of these Opportunity Zone things and log into one of these platforms, and 50 options just kind of like hit the screen, and suddenly the advisor's head is spinning around like the girl from The Exorcist, just overwhelmed by too much information. And this too much information is too much data out there is a problem. So the third-party reports are always really crucial to me. But support is there. I get pulled in regularly by a lot of these platforms when an advisor says exactly that. I saw 50 options. I don't know how to navigate this space. Can you help me? Hey, speak to our guy, Richard. So support is there. There's a lot of conferences out there which will really help you meet people in person, understand in the alt space specifically. Call me, request the third-party reports, ask the sponsors. It's certainly a good thing if sponsors who've been very product education oriented start getting questions from advisors and from clients. Well, actually, do you know what? I need to understand alternatives more, or I need to understand this vertical in the alt space. I'd love nothing more than sponsors getting hounded for more education because it's needed in the space. One thing I would say when navigating it is make copious notes for the regulators, particularly in product selection and rationale for billing. I get a pushback all the time from advisors saying, I don't think I can charge something illiquid under my wrap fee. I disagree. I think the work is front loaded. There's a lot more work, 3-4 times the work that would go into just picking a stock. So why can't you bill it for 3-4 years? You've just front loaded the effort. As well as that, you'll probably have to go on quarterly conference calls to get updates to share with your clients. You are continuing to diligence this and update. I've got no problem with that. But if you wanted to charge on your dual reg Series 7, that's fine. If you want to charge an upfront due diligence fee for a DST or something, that's also fine. Just make notes as to why you chose that product and why you build in the way you would. So what can we do about this? And then I'll stop banging the table about this alts being under allocated. Education, the most important thing. Hand-holding. clients hand-holding, advisors hand-holding with clients, people like myself hand-holding with advisors and clients, client messaging, understanding how to take something which might seem quite complicated like opportunity zones into a message which is a lot simpler, and helping clients understand that alternatives don't need to be this high-octane risky stuff. That needs work from sponsors, needs work from providers, from solution providers. Everyone needs to be focusing on this messaging and education because it's the only way we actually can pull together and demystify and destigmatize some of the alternative side of things. Okay, so let's actually finally get to the reasons why alternative investments. We've talked about the why nots, and I think we're good now, Tyler. If you want to, it's completely up to you. But if you want to turn off your camera, then you don't need to keep pretending to listen to me. Or
appreciate. I got to really scratch my nose. I appreciate it. Thank you.
No worries. Me too. Yeah, some of the reasons for alternatives: competitive advantage. If you're not offering these to your clients, someone else will be. If a client comes to you and says, I need opportunity zones, DSTs, and you don't have them, or God forbid, you don't even know what they are, real problem. So competitive advantage, client demand, client sophistication. To land the higher net worth, more sophisticated clients, you need more sophisticated products. Is a lot of these guys will understand at least some more of this nowadays. And if you don't have access to these quality products, you're in trouble. Competitors are using alternatives. They're using these tax structures, DSTs, opportunity zones. Business development. It's not just the incoming biz dev, it's actually outgoing. If you finally get the chance to play golf on the golf club with the guy everyone's trying to land, and the other advisors are, so who manages your 401k? Yeah, go away, never play golf with me again. In fact, I'll have you removed from the course. That doesn't open any doors, but yeah, I heard you had a really big capital gain and were kind of, dreading what you're going to do with that. How much do you know about opportunity zones? Yeah, I've heard it a few times. I don't know much about it. Do you know what? That's what opens the door rather than the basic stuff. So it's a great business development side of things. Fee compression we'll come on to in a minute, but we've talked about the less correlation to equity markets. It means that we are getting away from this kind of peaks and troughs cyclical. Let's have less correlated asset classes, especially now that it looks like the equity markets, this might not be a short-term blip. So it's important to have less correlated asset classes. I really like yield-based alts at the moment because it's hard to get yields in the bond market, and you're not looking for a quick capital appreciation flip. You are looking at a predictable yield play. Fee compression, I wrote an article about this maybe 18 months ago. In a world of fee compression, avoid the race to the bottom. Don't be trying to compete with Betterment at 15 bips. Keep your fee where it is, but just offer a better service. The way you offer a better service is not with another ETF. It's not with a robo. It's with quality alts product. And a client needs this tax solution, and you're able to provide an opportunity zone or a DST. They'll name their firstborn child after you. You just save them a huge amount of tax. So this is really important. We've talked about the less correlation here, and then real asset backed. A lot of these plays are backed by real assets, real estate, and especially if you're not looking for a quick buy, increase, and flip, you're actually looking at a long-term yield hold. You're holding a real asset, and it's a yield play. That is really, sorry, I've got a pet trying to crash my screen again. The joys of working from home. So if it's backed by a real asset and you're not looking for a quick flip, you're actually looking for a long hold yield. That's a great play, which is not the volatility of the equity market. So I really like the yield side of things. I think that's where people should be trying to replace their bond yields with real assets potentially. And if you're looking at a 5-year commercial real estate play as a yield play, you're not looking for that quick flip. You will continue holding it, and you're not waiting there with a paper gain or a paper loss. You're actually collecting your yield as the rent's paid. So yeah, I believe that the yield side of things is really compelling at the moment. Okay, low interest rate environment. Kind of just reinforcing my point I made a few moments ago, which is find your yields elsewhere other than bond yields, and do not be moving your bond allocations into equity, and definitely don't be sitting in cash at the moment here. So I'll just leave that a moment for you to take a look at those. And then here's something I really like talking about, and I just wrote an article about this, like as I said, on the illiquidity premium. So regularly there's a higher potential return in an illiquid investment or a less liquid investment than its liquid equivalent. So let's just take the example of a public REIT versus a private REIT. Let's say that a public liquid REIT is offering 3% and a private REIT is also offering 3%. 99.9% of people are going to go for the public REIT because there's liquidity there. They're not tied in. They're both offering the same. So guess what? The private REIT has to offer 5.5% to actually attract the money, because they need to be competitive in that sense. So the illiquid investment needs to offer that premium to attract the money, because if the two were exactly equal, same asset class, people are generally going to go for the liquid option. So higher potential return than a liquid equivalent, higher yield. There needs to be some carrot dangle to make people opt for the less liquid option. Often the NAV, the net asset value, is calculated more accurately than market sentiment. If this is something that's valued by a third-party appraiser and not just market sentiment tossed on the waves of the equity markets, you'll likely get a more accurate calculation of the real value. It also, something I mentioned in my market, gets rid of impulsive, stupid investing. Is how many people during March, what would that have been, 2020, when COVID was just happening, is pulled out of the market and then mistimed the exit and the entry. And that was impulsive panic selling. Long-term planning gets rid of impulsive issues. So if you've planned for something and you don't care if there's a short-term blip by 10% or whatever, because you know that you're getting a yield for 4 years locked in or something, it gets rid of impulsive, stupid investing. I like that approach, because I'd much rather plan and then not be spooked out by something as a short-term blip or something like that. But that does require careful planning. It requires you to know your clients' horizons, to know your clients' potential rainy day situations. So it does require more careful planning. But in no way am I saying that you should be tying up 80, 90, 100% of assets into illiquid investments. It needs to be a planned amount. And guess what? Is if you're in 100% liquid, you are leaving money on the table, because you're not getting that illiquidity premium that you could have got. If you're liquid for everything, you are leaving money on the table. Careful plan, and doing your clients a disservice, by the way, and not justifying your fee. This is another way you justify your fee, by doing correct diligence and very good planning to decide which percentage of a client's assets can be put into illiquid assets, so that you can capture that additional amount that you're getting for it being illiquid. And then we talk about reinvestment risk. Is what happens if someone takes an 18-month high yield opportunity, and at the end of 18 months interest rates have changed, and maybe you can't get that 5.5% that you were getting, and you'd actually match that with a potential liability in future, and then it's, I can't get 5.5% anywhere at the moment. I would tie my money up at 5.5%, 6% for a 4 or 5 year period in a heartbeat for some assets, because I don't want that unpredictability of having to, what are the interest rates going to do? Am I going to be able to replicate that somewhere else, or am I going to be stuck in a situation where I can't match that yield on the way out? That's reinvestment risk. Again, all about careful planning transparency, understanding this with clients. But if you don't have some illiquid assets, you are leaving money on the table, and you are not effectively earning your client's fee at that point. So there's just one other thing to mention in this, is that interval funds have some liquidity provisions, and I'm fine with interval funds. I would class that still under illiquid assets. I wouldn't say, all right, I've put 15% into completely 5-year illiquid assets. I can put the rest into interval funds because they have some liquidity. I'd still class interval funds as illiquid assets, but that's not a problem. Interval funds just offer some options for liquidity, but I'd still class them in my illiquid basket. Maybe you have a slightly larger allocation in your illiquid basket, a slightly higher percentage overall, because interval funds have a little bit more leeway. But I would still consider this. You do need to work out what your true liquidity is for any kind of change in life circumstances and things like that. So we're coming to the end here, and we're actually just going to do a quick Q&A. So I think I'm going to pass, and actually just before we do, here's my details. A lot of what I put up there in terms of articles and things are on LinkedIn. Richard Hilson, H-I-2-Ls, H-I-L-L-S-O-N. And there's my email address. So get in touch with anything if you want to learn more about alternatives, or you need help with messaging, understanding, navigating, any of that. So appreciate you guys coming on today, and I will hand back over to NuView. They've got, I think, a holding slide for the Q&A, and for anything else they want to say. And then, yeah, please fire away with any of the questions here.
Thanks again so much, Richard. Really appreciate your time. Super helpful, very knowledgeable. It's a very exciting time right now for the alternative space, and it's nice to be kind of on the front lines with NuView, seeing all that happen. And I personally have been in for about 5 years, and just to see this company grow from, I think there was maybe 17 to 20 people to over 50 now. It's been, in just a few years, literally tearing down walls in the building to keep up. So it's been a good combination of, the education you touched on earlier was great, where it's like, that's the biggest tool right now, is even if it's calling up Reg D sponsors who have filed their Reg D and they're raising capital, and just educating on the whole space of, did you know your investors can use qualified funds in their IRAs to raise capital and help you out with these types of, giving them another arrow in their quiver, essentially. So that education component's been crucial, and it applies to the advisor space too.
And that's a really good point that I should have mentioned in the illiquidity side of things. Is I do mention it in the article, but the fact that qualified retirement money is also okay to allocate to alternatives is again, that's not a faux pas. That's absolutely fine, and that is long-term money, which a long-term predictable yield play is perfect for.
Yes.
So, and the fact that you guys actually hold qualified retirement money as well in the alt space is really significant. I should have mentioned that earlier. That's really important.
Absolutely. Yeah. I mean, the illiquidity portion of it all is always a question when it comes to, personal funds, non-qualified funds. But when you can't touch it for years, then it's kind of like, let's just put this in the IRA, let it do its own work, and, touch it when we can. We do have a question here from Pete Luther in our chat. What are examples of current OZs that you like? I'm assuming opportunity zones, but you may know exactly what he's referring to.
Yeah, qualified opportunity zones. I don't really want to go product specific on kind of like a general call, because I don't know everyone's circumstances, but there's a number of opportunity zones that I work with and I really like, and I'm happy to talk to you offline about kind of, you tell me what you're looking for. I can certainly point you in the right direction. So please email me. You've got my email address, or ping me on LinkedIn. And I'm happy to have that conversation there.
Perfect. Thank you. Question here: Does the market influence a push towards a specific type of alternative investment, a specific space? Do you see it being affected in certain types of asset classes and not others, or has it just been alternatives across the board seem to have been growing here lately?
I think alts across the board, but it also depends where we are in the cyclical side of things. Is that I know when even 18 months ago, when it was predominantly yields that were looking to be replaced is a lot of people were going into real estate, which was yield based and not worrying about capital appreciation. So it was yield based real estate, which was really hot.
Mm-hmm.
I guess over the last 6 months, where people have realized the equity markets, yes, we've been worried about yields for a while. Maybe we should be more worried about equities performance. People are actually now starting to look again for capital appreciation plays. And that might still be in real estate, but it might also be in other things. So I think market conditions drive. And I was at an energy conference. A lot of oil and gas actually got back. Was it Tuesday? And obviously that is sexy and topical at the moment because of where oil price is, and a lot of people would really want to know, is this sustainable or whatever. So I think market conditions drive what is the the bell of the ball in the alt space at the conferences, but overall exposure is increasing. And I would always say that advisors need to have at least a small menu, and maybe that is one yield REIT, one capital appreciation or hybrid REIT, or real estate opportunity, maybe one private credit, one opportunity for some private equity kind of pre-IPO, late stage pre-IPO opportunities, at least one or two OZs, one or two DSTs, and then kind of anything else that's an outlier there that's interesting. What one energy play, that's probably only a 7-8 piece menu, which is pretty easy to start with. And an advisor could get their arms around that fairly easily. And then if you've got, that's then your mini menu, your happy meal mini menu for all of your clients regularly. And you get someone who's high net worth and sophisticated and says, I need an energy play. I need to get in oil and gas at the moment. What have you got? All right. Then you go and find 6 or 7 different individual sponsors within that to cater for that client. And that, again, is not that difficult to do. But I'd suggest that all advisors have that happy meal menu, which is small, kind of basic. Here's my go-to in this space that I like and I'm comfortable with. If someone wants to go deep with that and they're a sophisticated client, that's absolutely fine. We can find some more. But at least here's my basic diversified menu. And with 6 or 7 with the minimums, I mean, what you're looking at, 200 grand to probably fulfill that mini portfolio.
Right.
It's not difficult nowadays. That would have been 3, 4, 5 million bucks to even fulfill that even a few years ago. So
Right.
For most clients, most accredited clients, you can fulfill that mini portfolio.
Right. Yeah, it's a great point. And kind of on piggybacking off that real quick, and possibly the last question, may have one more time for one more. The investment minimums, as you had talked about, are getting way more accessible. That kind of barrier to entry seems to be going away a bit more, which is great. For those who are just now starting to save for retirement specifically, or just have a bit of a savings account started for whatever it may be, personal funds, passive investments, do you encourage, or do you see or recommend or prefer a certain type of alternative that maybe has a lower bar of entry in terms of investment minimums, or maybe someone doesn't have a ton of money in their retirement account? Do you see alternative product out there that may be better suited for their current state of their savings account? Does that make sense?
Yeah, I think I think for me it depends on the minimum ticket size. There's one product at the moment which I think it's $2,500 minimum ticket size, which is that's low even nowadays, but
Absolutely
quality product. And so if it was someone in their 30s or something who's just starting to build a retirement account and started off with equities and now needs to, then that's a driver. And I told these guys, I said, I think you hit the nail on the head here, is they've got one fund with a slightly different fee structure with a higher minimum ticket size, and they've got one which they're kind of almost running like a quasi-public fund because it's evergreen and it's got a low minimum ticket size. So I would say that low minimum ticket size doesn't mean quality, but if you've done your diligence and it's quality and it has a low minimum ticket size, then I think that's really good. Because what I wouldn't want to do is someone who's just dipping their toe, who's mid-30s and just starting to, build up money in a retirement account, puts their whole 50 grand allocation of alts into one thing. That's not smart. Unless, I don't know, let's say they work in the oil and gas industry and therefore they know it and they really want to double down because they they know oil and gas. You can't argue in those situations.
Right.
But for most people, I'd say this mini portfolio approach is a really good way to do it, especially for people dipping their toe in the water.
Yeah, great point. I think we'll just do one more question. This one's actually from me. So quick question for you. Alternatives, NuView, we're an IRA custodian. We do non-qual accounts as well for our advisors, but we're primarily qualified funds, tax-deferred, tax-advantaged funds. Do you see in the alternative space product that is better suited for the non-qual account versus the qualified tax-deferred retirement account? Is there a difference? Is it kind of alternatives should appeal to all types of investments and investors? Or do you see kind of these should be earmarked more for the retirement account? These types can be more for that passive income day-to-day investment.
Yeah, so I think alts are suitable for both and should be in both. I think that it's probably an easier sell to clients, or I don't mean sell. It's probably easier to get a client across the line, and
right.
It should be across the line, but they might have their be concerned about the asset class, incorrectly so.
Mm-hmm.
But if it's easier to get a client comfortable with a 5-year illiquid hold in their retirement account than it is in their free money. However, on the other hand, sometimes the regulators consider retirement money to be the most conservative side of things, and the regulators are getting better, but they might have found it harder to justify alts in retirement accounts because retirement accounts are sacred and need to be the most conservative. Well, actually, if you really did your job properly, you'd realize that a 5-year real estate yield play hold is actually lower volatility, lower risk than an equity play.
Right.
Because it falls in the alternative bucket, you're doing your job poorly or whatever. So regulators are getting better in that space, but I think it's easier to get clients comfortable with the illiquidity option in retirement accounts. But equally, we need to be more conservative with what we're putting in retirement accounts, particularly for the older clients. For younger clients who want to take on some risk, that's absolutely fine. But I think alts should be in the regular account and in the retirement account. And you can get more liquid alternatives, which are more suited to the regular account. You're obviously never going to get, well, very rarely get daily liquidity, but there are more liquid alternatives, which
yeah, we see alts that have monthly distributions, quarterly distributions, yeah, definitely. Absolutely.
And on the distribution side is maybe it's a case of a lot of these have the option of either doing a roll-up unit where your 6% goes back in and buys more units,
right?
So accumulator compounding. Maybe that's the one that you put in your retirement account, and if it's got an actual monthly paid out, that goes into your regular account and you actually take the cash out. So there's plenty of options there. It's very client specific, but very long-winded way of saying alts should be in both accounts. Different types of alts suit each differently, but yeah, they should be considered for both.
Great. Wonderful. Well, Richard, thank you so much for your time today. We are very happy to have you on. Very useful information, very helpful, very educational. So we look forward to continuing to work with you. Thanks for everyone that joined us today. We really appreciate your time and attendance here. Real quick, just to stay up to date with NuView, we've got a QR code here. We are on all the socials, Facebook, Instagram. We have wonderful educational content on YouTube, LinkedIn. Videos such as this will be saved in perpetuity for future use education for whatever you'd like on our blog section on the website. Any questions, contact us. We've got our phone number and email address right there. Again, thank you everybody for your time. We really appreciate you. Have a good day.
Thanks. Bye.